Okay, good afternoon, everyone. This is Mark Rylance at Crum. We wanted to give you just a very quick update on the financial markets. There is a lot of volatility. For example, the markets were down 3% yesterday, and then they're back up 2% today. That's been going on over the last month or so. And for those who have not been peeking at your investments every day, good for you. That's the best way to handle these bear markets. But I wanted to just take a few minutes and kind of go through what we feel are the important points so that we could kind of help control the narrative versus what you might be seeing in the headlines or on the news. So with that said, let me go ahead and kick this off. I have a pretty short presentation, and let me go ahead and kick it off here. Okay, so some of the economic themes that are going on right now. Let's first talk about there's headwinds and tailwinds. So the headwinds are one of the big ones, and that's why the bond market, which most people don't pay attention to as closely as the stock market, we've had a very steep rise in yields, which means prices are kind of under pressure on the bond market. What's happening behind the scenes with all the tariff talks, but also, that's creating some anxiety in the markets. But also, we have a huge amount of treasury debt that needs to be refinanced this year. That's definitely a headwind. We can talk more about that in a second. We also have a debt maturity wall, which I'll show you what I mean by that in just a second. Basically, it means that we just have a lot of debt that needs to be refinanced over the next 12 and 24 months. Got the tariff issue. There's two sides of the tariff issue. One is, just the actual tariff itself, which when passed on to consumers, people are worried about that being inflationary, which rightly so. But the second thing, which could have an even bigger impact, is companies are kind of frozen in their operations trying to figure out what the policies are going to be. So if you are a US company manufacturing in China, and what are you supposed to do at this point with no clarity, or South Korea or Japan or what have you? So that also is creating a lot of anxiety. We also have, take a step back before the election and before the tariff announcements. There were certain air pockets in the economy that were already slowing. A lot of the stimulus money the COVID stimulus money had already worked its way through the system as of the end of last year. And so we've seen, I won't go into this, but we've seen consumer credit cards, the default ratio is the highest it's been in either on record or certainly in the last 20 years. We have car loans that defaults are going up. Student loans are becoming an issue. So the middle class and down, there's a lot of pressure on them, both from inflation and also just servicing their debt. So again, the economy is split into two stratospheres. One is the very rich who have been doing extremely well, and then everybody else who is seeing significant pressure. So those are some of the headwinds, but you always have to keep in mind there's tailwinds as well, that with all the Trump talk and all this stuff, you need to keep perspective that he is basically taking a sledgehammer to regulations. So when you reduce regulations, typically that is stimulative for companies and for economies. We have seen lower energy prices, which are part because of the volatility in the markets, but also the Trump administration's focus on drilling and so on and so forth. Also, there is I don't know if this is a tailwind, but diversification in your investments is now starting to work, which I'll show you that in just a moment. And also, don't forget the US markets. They're still the envy of the world. We have the most transparent financial markets. There is a rule of law, and that's unparalleled with other institutions. So you kind of have to think, where is money going to end up if it's not in the US? Is it going to go to China? Is it going to go to Europe? I still would be betting on the US. So all this stuff that, all those headwinds that I just mentioned, you can see it is now taking a toll because in the Wall Street Journal poll of economists, there has been a significant spike, more than doubling of the likelihood of a recession in the next 12 months. And that is because of all the stuff I've mentioned. Back to the diversification, I kind of jumped ahead of it, but I want to kind of give you context before we go into all this stuff. Diversification is working. You know, with our clients' portfolios, the stock portion, we do have U.S. stocks, non-U.S. stocks, international, developed, which is Europe and Japan. We have emerging markets, large cap, small cap, growth, value. And basically what we said in the writing that we sent out not too long ago, a few weeks ago, is at that point, the average client with a 50% stock portfolio was only down around 1%. Now, as I looked this morning, and again, it's April 22nd, if you had a 50% stock portfolio, I'm showing clients are down around 2%, even when the total U.S. stock market down is down 12.5%. So we're real pleased with how we're doing. Also, we're set up intentionally to outperform in down markets, and that's a very big focus of ours. And then participate as much as we can, if not all, on the upside. But just to show you, here's how the markets are looking. So, oops, let's see here. Oh, okay. There we go. So as you can see, we have U.S. large cap stocks are down 15% for the year. U.S. small cap stocks are down 16%. Now, small cap stocks typically have higher returns than large cap stocks, not in the last 10 years, but over the long haul they do. So this doesn't surprise us. There's more volatility. And when we do emerge from this, this period of time, I wouldn't be surprised if small cap stocks lead us out of that. But that's not the whole story. We also have money in value stocks. You can see value stocks are only down 4.5% for the year. And if you just take out the growth stocks, large cap stocks in general are down 10%. We also have 35% of our stock money outside of the US is split between international, developed, and emerging markets. So emerging markets are down about 0.5%. But here's the big story: international stocks, and this is developed stocks. So this is primarily Japan and developed Europe. They're up almost 7% for the year. So when you layer in all these things, the stock portion that we're managing is down about 7%. But our bonds are up and our alternative investments are up as well. So that leads to the overall portfolio on a 50% stock portfolio being down about 2%. So I'll take that all day long. If you have half your money in stocks, which the total U.S. stock market is down 12.5%, and you're only down 2%, we're pretty pleased with that. So moving forward, some of these headwinds, this is a biggie, and this is going to be managed through this debt maturity wall. There's basically, $2 trillion in global corporate debt that has to be refinanced this year. And then there's another $3 trillion next year, refinanced at higher interest rates. A lot of this debt was pre-COVID debt or when interest rates were, 2%, 3%, 4%. Now these companies are possibly going to be refinancing at 7 or 8%, which that is going to be, quite a big deal because number one, they have to be able to refinance and get a new loan. And then number two, they have to be able to service that loan at interest rates that are basically double what they currently have prior to maturity. We also have a bunch of commercial real estate debt that has to be refinanced. $300 billion in, I'm not sure if this is the US, and then $163 billion next year. But the big whopper, as I mentioned, is the U.S. government debt. This is treasuries. And just in 2025 alone, starting, I believe, in June, the Treasury Secretary Bessent is going to have to refinance $9 trillion of debt. And that is over 30% of our overall debt. And with China not specifically, not necessarily a strong buyer right now, even Japan, who has the most treasuries of any foreign country, has been selling a bit of their stuff. And you're seeing a lot of these, some selling of US debt and a lot of purchasing gold. So if in fact we have problems with that auction, one of two things is going to happen. One is the Federal Reserve is going to come in and buy that debt, which is the akin to printing money, which is inflationary, which is why you may see several new investments in our portfolio is we're hedging against inflation. The second thing is if the Fed doesn't buy it and an auction fails, then the government has to go back and charge and offer a higher interest rate, which given the amount of debt we have, that's going to put pressure on our economy as well. These bear markets are common. This is the number of corrections we've had since 1940. And you can see we're on the left column 32 times since 1940 if we had a 10% to 20% correction in any given year. We're in that range. Now, granted, this could be the beginning of going to a 20 to 30%, which has happened 7 times, or 30 to 40%, which has happened 4 times, 40% or worse has happened 3 times. So to keep things in perspective, I know, we have the Great Recession, which is still burned in our memory, but those type of markets are not very common and don't happen very often. And just to show you, the green blocks here are the positive years, and you can see at the bottom, 0 to 10%, 10 to 20% is the most common upside market. But on the red are the down years. And you can see 2025, we're in that 10 to 20% range. And again, if you look to the left of that, it doesn't happen very often. It's certainly possible, but it doesn't happen very often. And so we need to keep our eye on the ball of that. This could very well be in the middle of a 20% correction that solves itself when tariff negotiations hopefully are resolved. This is, another chart which kind of goes through 2025, the first 72 trading days of the year. And as you can see, this year it is pretty intense. It's a top 5 ranks since 1928, being down 10% in the first 72 years. And as you can see on the right column, the full calendar year where we end up, it's a mixed bag. And so I wouldn't necessarily think that we are going to end the year up, because history tells us it's, it looks like maybe 60% down years, 40% up years, something like that. Here's another very, very important, sorry, this is a little fuzzy, but very important concept to understand. And we've talked about this in the past, but when you take the US stock market, or any stock market for that matter, in context, typically where the markets are trading today is based on what they believe the economy or earnings will be 6, 9, 12 months in the future. Okay. So what could be happening right now, the moral of the story is the market could completely recover before we see the significant pain from a slowing economy or a hit to earnings. As you can see right here, this goes back to, the COVID time. The S&P 500 hit a low, I guess it was March 2020, but the earnings didn't hit a low until a year later. But you can see the market, if you look up top, had already recovered well in advance before the earnings in the economy had recovered. So again, the moral of the story is what we're seeing today is not where the market's priced. It's what it's expecting to see in the future. So if things start improving, The market's going to be front running that and be well ahead of that. So that's why you need to stay invested. The good news. So let's talk about some good news. So returns after 15% drawdowns. As you can see, after 1 year, this is the average return since 1950. Okay. And 83% of the time, you have a positive 1 year trailing record after you've been through a significant or 15% decline. The average return is 15%. If you look 3 years forward, 96% of the time, you're positive 3 years later. 5 years later, 92% of the time, and then 10 years, 100% of the time. So I know it's hard to keep focused in times like this because there's so much. We have both economic issues and we also have political issues. But the thing is to remain calm, stay the course. We're going to be doing our trading and rebalancing as markets and opportunities present themselves. If you do want to take advantage of some of these lower prices, because we're going to always, if you're a 50% stock portfolio, we're always going to be rebalancing back to our normal targets. But, if the market goes down 20%, 25%, 30%, for those who have a higher risk tolerance, that is a time maybe you can take your risk level up a little bit and take advantage of some of these depressed prices. So hopefully that was kind of helpful to just show you the context. But the good news is diversification is working. That's the most important thing. That's why we diversify. And for a long period of time, it wasn't working because U.S. stocks was the only game in town. But we're starting to see international stocks take the lead because they're cheaper overall. And also, another factor I didn't mention is the dollar is really under a lot of pressure right now, which helps international and emerging markets. So again, there's a reason we have cash, fixed income, various types of stocks, and alternative investments. If we've designed a portfolio of investments properly, that means there's usually always something that you're not happy with, something that's not working or down. But in times of need, in times of stress like today, in today's markets, your investments being diversified is helping you reduce that volatility. So with that said, I want to thank you. If you have any follow-up questions, just send us an email, reach out to your advisor, give us questions you have, and we'll address it in the next video. So thank you very much, and I hope you have a great day.